Welcome back to the Deep Dive. Our mission today is to really cut through the noise on a major geopolitical flashpoint, one that's reshaping energy markets, maritime compliance, and maybe most surprisingly, long-term U.S. naval strategy.
We are doing a deep dive into the U.S. governance, let's call it aggressive new posture in the Caribbean. Officials are calling it a maritime quarantine, and it's specifically targeting oil tankers linked to the regime of Venezuela's Nicolas Maduro.
Right.
What we're really seeing here is a convergence of sanctions enforcement, military strategy, and some very volatile oil dynamics. It's sending critical signals.
And this isn't just a Treasury Department press release, is it? This is a full-scale deployment of military muscle. So what are the core facts? What are we actually seeing on the water right now?
Well, the scale is it's pretty unprecedented for this kind of enforcement action. We're talking about U.S. forces, including assets from a carrier strike group, advanced F-35s, and a lot of specialized Coast Guard cutters, all of them deployed to strictly enforce this crackdown on Venezuelan oil.
And how broad is this deployment, really?
Oh, it's massive. This is the most expansive maritime enforcement action of the current administration. You've got roughly 15,000 personnel positioned all across the Caribbean and the Gulf of Mexico.
15,000?
Yeah. And the goal is, pretty straightforward. Stop, board, and inspect vessels they suspect of transporting sanctioned crude. Sanctioned fuel is, quite literally, unable to move through these waters without facing interdiction.
And we know this mission has already had some tangible results.
That's right. This deployment follows the seizure of multiple oil and merchant vessels, including that high-profile tanker they intercepted around December 10th, 2025. And in parallel, the Treasury Department just sanctioned 4 specific vessels and their owners.
Which vessels are we talking about here?
They targeted VLCCs, very large crude carriers. I mean, these are the ships capable of carrying 2 million barrels of crude oil.
The real supertankers.
Exactly. Specifically, the VLCCs Della and Valiant, along with a mid-sized Panamax vessel, the Rosalind and the Nord Star. These ships and their owners were cited for being part of that notorious shadow fleet and for active sanctions evasion.
2 million barrels per vessel. I mean, that's just a staggering amount of cargo. It really puts the scale of this whole thing into stark relief. So what was the immediate market reaction to this physical squeeze?
Well, the oil markets reacted almost instantly. The physical risk just became very, very real. West Texas Intermediate, WTI, it surged over $58 a barrel right after the news. That's a 3% weekly gain, the biggest jump since, late October?
And if you're tracking supply risk, this is a huge signal.
It's a clear signal that the enforcement is working. I mean, almost no crude tanker traffic has moved out of Venezuela's main ports since that big December 10th seizure.
Okay, so we have a clear, immediate price spike driven by supply being taken off the market. But let's dig into the mechanics a bit. How does this enforcement action target the tactics these ships use to evade sanctions?
Right, so this is where we move from just stopping ships to strategic compliance. U.S. forces are operating under existing sanctions authorities, but the key is also standard maritime law. That law allows for boarding when a vessel is suspected of concealing its origin or, violating international reporting rules. Washington calls them illicit tanker actions.
And what exactly makes an action illicit in this context? Because this is where the compliance risk really starts to bite for the entire global shipping sector.
So the protocols are really designed to disrupt the main tools of deception. First, they're going after flag spoofing and shell company registries, basically creating these opaque ownership structures using flags of convenience to hide who actually owns the cargo or the ship.
And the second one?
The second is ship-to-ship, or STS, transfers. These often happen way out in open waters, far from any port, specifically to mask where the crude originally came from.
And I imagine the third tool is maybe the most critical one.
Absolutely. The manipulation of mandatory location data. They're targeting AIS, that's the Automatic Identification System blackouts, or what's known as spoofing.
Yeah.
Think of AIS as like a digital fingerprint that all commercial ships have to broadcast. It's for preventing collisions, tracking trade.
So turning it off is like taking the license plate off a truck full of illegal goods.
Exactly. It is a fundamental breach of international maritime norms.
The Office of Foreign Assets Control, OFAC, has been pretty explicit about this stuff, right? They've been warning stakeholders, insurers, brokers, ports to do deeper due diligence.
They have. They've highlighted a bunch of red flags, like modified documents trying to hide ties to sanctions or these murky ownership structures with shell companies. The key compliance lesson here, especially for non-U.S. persons, is that if you facilitate this evasion, you expose yourself to U.S. secondary sanctions risk.
And this whole operation is really aimed at what we call the shadow fleet. This fleet has, it's evolved way beyond just a fringe strategy for Iran. The scale is now truly global because of sanctions on Russian, Iranian, and Venezuelan oil.
That's completely right. The vessels being targeted are part of this growing shadow fleet, which has ballooned to about 1/5 of the entire global tanker fleet.
A fifth, just to transport sanctioned cargo.
Just for that. And a major vulnerability for these vessels and a huge risk indicator is their insurance status. They often operate outside the traditional Western international group of P&I clubs.
Okay, hold on. For our listener who might not be deep in maritime finance, what does operating outside the international group of P&I clubs actually mean?
So the international group, or IG, of P&I clubs, that stands for protection and indemnity, is basically the backbone of global shipping insurance. They cover about 90% of the world's commercial tonnage. They are the gold standard for liability coverage. Think massive environmental damage, third-party claims.
And when a ship operates outside the IG?
Its insurance is often cheap, inadequate, or it's from some, obscure, newly created entity with very questionable financial reserves.
So what's the tangible financial consequence of operating outside that gold standard system?
It creates a massive risk multiplier. Mostly because these vessels are often very old. Over 72% of shadow tankers are over 15 years old, and they're poorly maintained. So when, not if, a catastrophic oil spill or a collision happens, the financial burden falls on coastal states, local governments, or the insurers of the other ships involved. Because the shadow fleet's insurance just isn't going to cover the multi-billion-dollar cleanup costs.
It's a classic externalization of risk. You're pushing the environmental and safety liabilities onto everyone else. Now, let's pivot to the political and legal pushback on this U.S. quarantine. The framing here is obviously very contradictory.
It is. It's complex. Venezuelan officials immediately called it piracy, illegal interference. But the more serious legal challenge came from UN experts who declared the action a maritime blockade and a violation of the UN Charter's prohibition on the use of force, Article 2.4 specifically.
A blockade. So they see it as a breach of freedom of navigation under the law of the sea.
They do. They view interdicting foreign flag vessels on the high seas as a clear breach.
So how is the U.S. justifying this pretty aggressive use of military assets?
Well, the U.S. avoids the word blockade entirely. Instead, they frame the intervention as absolutely necessary to cut off revenue that funds corruption networks. They're integrating sanctions enforcement into their broader national security strategy against what they call narco-terrorist threats.
Which aligns perfectly with the 2025 National Security Strategy. It feels like a pivot from enforcement being a purely economic Treasury function to a kinetic Navy and Coast Guard function.
Precisely. They are reasserting a long-standing view of the Western Hemisphere and elevating sanctions enforcement to a core security priority. But critics, they highlight the contradiction here. The U.S. routinely condemns Iran for seizing tankers, citing freedom of navigation, yet here the U.S. seems willing to operate outside of those norms to enforce its own sanctions.
The political tension is obviously palpable, but the strategic intent is very clear, which brings us back to the market. So let's connect this to the bigger picture for investors. Beyond that immediate WTI spike, what are the durable implications here?
The physical supply risk is still very acute, especially for regional players. Economists are predicting that the redirected tanker traffic and higher prices are going to hit Caribbean importers in U.S. Gulf states first.
Right. And this is all happening while we're seeing increases in U.S. Gulf sour crude supply from Canada and new deepwater projects.
Exactly. So you have this high-level geopolitical risk pushing WTI up. But at the same time, specific regional dynamics are keeping Gulf Coast sour crude somewhat tempered. But I think the biggest structural shift for investors is actually in the maritime compliance space.
How does an active military crackdown change the calculation for, say, an insurer or a broker?
It dramatically elevates the risks. The threat of dealing with the shadow fleet has shifted from, a theoretical OFAC fine to the very real possibility of your vessel being detained and facing major financial liability.
So OFAC guidance becomes much more important.
It becomes critical. They're making it crystal clear. Maritime stakeholders have to implement robust compliance. That means better document review, using enhanced tracking systems to spot AI spoofing, and ensuring all your contracts have strong sanctions exclusion clauses.
Okay, so if we look at this through a long-term spending lens, the need to police a fifth of the world's tanker fleet with naval assets seems massive. This feels like where operational reality starts to drive industrial policy.
That's exactly it. The maritime campaign is explicitly linked to a broader, long-term push for a significant shipbuilding expansion. The reality of stopping and boarding thousands of vessels across a huge area has basically proven that the current Navy and Coast Guard fleet structure just isn't adequate for this kind of sustained enforcement role.
So this whole operation is acting as a real-world proof of concept. It's justifying a new class of ships.
Absolutely. The administration is accelerating procurement of larger surface combatants, support vessels, things you need for prolonged operations far from port. And they're tying the new funding to partnerships that blend traditional shipbuilding with AI and advanced combat systems for automated tracking and threat detection.
It's a very muscular, long-term vision for sea power, centered around sanctions enforcement. For industrial investors, this is a clear directional signal for defense procurement. Sanctions policy is now driving shipbuilding policy. All right, now let's move to the provocative part of our deep dive. Given the geopolitical backdrop, the shadow fleet disruption, the surge in naval spending, let's pitch an outrageous but plausible trade idea for the quarter. And remember, this is purely for entertainment and discussion. It is not to be construed as financial advice.
Our analysis is pointing to a structural bifurcation here. You have acute physical risk on one side, and then these explicit political tailwinds for defense infrastructure on the other.
Exactly. So we're pitching a classic structural long-short trade based on that enforcement wedge, we're calling it. Long the American sea power basket, short the gray fleet proxy.
Okay, walk us through the long side of that.
Action 1. Go long U.S. defense primes. You establish a long position in the major U.S. shipbuilders and defense contractors who are directly linked to surface combatant and specialized Coast Guard vessel procurement. We see the Venezuelan quarantine as a political catalyst. It's a successful, necessary, real-world test that creates a strong political imperative for sustained budget allocations. You're betting on sea policing translating directly into hardware contracts.
And the riskier short side, which capitalizes on that compliance crisis.
Action 2. Short the gray fleet proxy. Here, you'd initiate a short trade on the oldest crude oil tanker companies. You'd focus specifically on publicly listed ones where the average vessel age is over 15 years, they rely heavily on the spot market, and crucially, they lack that deep-tier P&I club coverage. The military interdiction and the global scrutiny on insurers just massively increases the risk of detention, deflagging, and major liability events for this very specific, vulnerable segment of the fleet.
So that's a structural dislocation trade. You're essentially betting that compliance risk just became hard military risk, and that skyrockets the cost of debt, insurance, and just operating for that older, higher risk tonnage. To wrap up this deep dive then, the key takeaways are really the convergence of military force and economic sanctions in the Caribbean, the WTI volatility that resulted from that, and these fundamental heightened compliance challenges for global maritime trade.
For you, the investor, the immediate action is to monitor the legislative movement around naval budget allocations. This specific enforcement action could define defense spending priorities for the next decade. And ultimately, the durability of the maritime rules-based international order is being aggressively tested here. The outcome will define not just the future of Venezuelan oil, but the future stability, risk, and cost of all global high seas trade.
Until next time.